Hi, everybody, and welcome back to yet another cracking installment of the Map Round Show. This is the Private Placement Perspective series where I'm connecting you to investors, managing partners, who is exactly who I'm going to introduce you to today. His name is Ed Patowski. He's the managing partner of Chapwood Investments. Ed, welcome to the show.
Well, thanks for having me. I appreciate it.
The privilege is all mine. For our audience around the world, Ed, would love for you to kick us off. Tell us a bit about Chapwood Investments and how you got started in the investment world.
So I got started. I grew up at Morgan Stanley, and my father, who was a securities attorney, gave me the greatest advice at all. He said, you can try to be an investment advisor, but you're never going to be any good at it, which was discouraging. But I set out to show him wrong. And I'm proud to say I became the top producer at Morgan Stanley in the whole country at one point. And eventually I left there, went to Bank of America during the Glass-Steagall Act, when Glass-Steagall Act went away. And they didn't have the infrastructure at that point to support my business. So then I eventually went out and started Chapwood Investments. So we're an independent, federally registered securities firm. And, we oversee quite a bit of money. And we follow, some basic methodologies that most people don't follow. And that's something that really separates us from other firms. And hopefully we'll be able to get into that a little bit.
Yeah, well, let's do that now. That was one of the things I was going to ask you, what would you like the world to know about your firm that, that makes you guys different? Like, what's your secret sauce? So let's do that now. What is that point of difference?
Well, what got to me was I didn't like the idea of people referring people just because they were familiar with them. And I get a lot of referrals from people, and I want them to refer people. I want them to refer me to their friends not just because I'm, quote, a good guy, but because there's something worthwhile about what I do. And I realized that a lot of people just, are familiar with somebody. They know somebody from a country club, a tennis club, and they refer people, but there has to be a methodology. And I realized that there wasn't. So I created these 8 metrics on how to properly evaluate a portfolio. And the first one is, what rate of return do you need to make after fees, after cost of living increase, and after taxes? People don't really know exactly what they need to make. Then you look and see what standard deviation number that you're accepting. And you want your standard deviation to be 0.8 or lower than your historical rate of return. And the majority of retail investment portfolios, and this is one of those secret sauces, but the majority of retail investment portfolios are taking far too much risk for the expected rate of return. So if you had a portfolio with a rate of return of 10, and most portfolios, if they have a rate of return of 10, have a standard deviation of north of 15, that means you're taking 1.5 times the standard deviation, which is just far too great, which then brings us to another term that I made up. I completely made this up, and it's called variance drag phantom tax, VDPT. And your VDPT is the equation between your standard deviation and your historical rate of return. So you want your historical rate of return to be 10 and a standard deviation to be 8 or lower. And then the other thing that separates us is that we ask people, what is the probability of any loss in the next 12 months? Because if a lot of people, a lot of financial advisors give people, lots of different investments, but they don't know what the collection of these investments should render. What is the general purpose behind these assets? And what should this mix give you? What is the benefit of this mix? And most people don't know what that is. And so if somebody came up and said, I have a historical rate of return of 10 and a standard deviation of 15, and you have a 30% chance of a loss in the next 12 months, people would say, well, I don't want anything to do with that. And as a result of that, that's one of the things that we really focus in on is how much risk you're taking and what the probability of a loss is. And it should be 15% or less. And then I go into a couple of other metrics. So those are some of the things that separate us. And we try to, every day I wake up and I'm thinking about stealing business away from my competitors. I love nothing more than to yanking business away from Morgan or Goldman or UBS, Merrill Lynch. I just love it. But I love doing it with sophistication where I'm not being salesy. I'm just showing people actual numbers. So I put all this stuff on my website, these calculators that are able to analyze existing portfolios. But that's what I do every day. I love it.
So I was reading up on you, Ed, and you do mentor a lot of up-and-coming athletes and their parents about investing. And it's interesting. I've got a friend of mine, Chad Burmeister, and he knows a guy. And it just came up. It keeps coming up weirdly enough. And this was a recent conversation I had around, professional athletes or equal or AKA HNW, high net worth individuals who actually don't really know how to effectively manage the money that they've come into. Like it happens overnight almost in many cases. And then it becomes a case of, well, what do I do with it? And I'm curious to get your view on what's the role of private placements in that context. So you have a high net worth individual. They're looking for obviously a balanced portfolio, a diversified portfolio. But in the private placement space, there's a huge opportunity to take a little bit more risk, but also to get a higher point of leverage. Like if you're doing, if you do like a deal with a fund that's looking at an equity growth fund for argument's sake, and they're looking to purely do private placement, common stock or preferred stock, offerings. Walk us through how much of your world is based in private placements.
Mm-hmm. So I'm happy you brought that thing up about the athletes, because just to give you a little background, I did an article in Sports Illustrated called How and Why Athletes Go Broke. And it was in March of 2009. And then we turned that into a 30 for 30 on ESPN called Broke. So if anybody watches it, I put that together and I'm in it about 30 different times. And so I really started, because of a relationship I had here in Dallas, I really got into teaching athletes about how to properly manage money. I wrote a book recently called Never Go Broke, an investment guide for professional athletes. And in that book, you'll see that what I talk about is that until you have $3 million put away, you should not put any money in anything that's below the liquidity line. And below the liquidity line is real estate, private equity, and venture capital. Once you have $3 million put away, then you should have 7 to 12% of that money in real estate, 0 to 10% in private equity, and 0 to 5% in venture capital. Now, in private equity, what you should easily, one of the great, simple things to do is look at an investment. And if you are not expected to get 3 times your money in 5 years, you don't do the investment. It's that simple, because you can do double your money in 7.2 years in the public markets. So if you're going to tie your money up in the private investments, you should demand a much greater rate of return from that. And far too many people don't look at it that way. They'll say, well, it's private and I'm getting 6-7%. Well, that's not good enough. You should demand a lot more if you're going to tie your money up and have it illiquid and not be able to get to it. And then on the venture capital side, you're looking to put 0 to 5% of your money, because most of those are not going to work out. The chances of your friend's friend, brother who happened to have known, Michael Dell, isn't going to necessarily have the inside, scoop on making something successful. So you really, need to understand that you have to manage it from a 30,000 foot view and doing it that way. And then on the private equity side, you should look to have about 5 to 10 different private equity investments. And so that's how I look at it. And that's how I allocate money. But you shouldn't do it until you have $3 million put away.
Right. What about the other guys who fall below that? What's your advice to them?
Well, then they should have non-correlated assets, and above the liquidity line, you have liquid alts, and you have alternative investments that you can get into, which you should absolutely have in order to reduce risk in a portfolio, you have to have alternatives in that portfolio. Otherwise, the correlations are very, very high and everything's going up and down together. And you don't want that. You want to have some things that can go up when other things aren't going up. And you want things to, kind of balance each other out. And you're not going to be able to get a low, or you're going to get a highly correlated portfolio if you're not using alternatives. And the liquid alts are wonderful. These are ETFs that are made to replicate alternative investments. And that's where I would get my non-correlation from.
Mm-hmm. Yeah, I was speaking to Ben Lyon just literally an hour ago, and he runs Link Capital, high net worth individual, also written a couple books. And he was talking about, we were talking about leverage and how important leverage is when it comes to making any kind of investment, specifically if you are looking to get a particular return like the one that you mentioned. Leverage, I would imagine, is a very important conduit to achieving that kind of outcome.
Well, it depends if you're doing leverage inside the investment or if you're leveraging your investments. And if you're leveraging your investments, you should not go above 15% leverage. And just because, once you get to 30%, then you're running the risk of getting a capital call, and you never want to get a margin call. And recently, interest rates have risen so much that the best you can do on margin right now is about 5.5%. So you have to be able to do a lot better than 5.5% multiple times to be able to take advantage of leverage. Now, if you're talking about leverage inside investments, I'm all for that. Direxion has a bunch of ETFs that are leveraged, and I love them. I love Labu, which is a biotech, 3 times. I like Fangu, FNGU, which is the top 10 technology stocks, and that's leveraged. I really like leverage quite a bit inside the investments. I don't have a problem with that, especially if you're making a tactical play versus a strategic play.
Ed, lots of talk about the economy. Is it a recession? Is it not? Is it somewhere in the middle? What role does macroeconomic factors play in your mind when it comes to making investment decisions?
Yeah, well, it's everything. It's a top-down, bottom-up, and the top-down has to do with the macro. And you can't fight the Fed. I've tried it; it doesn't work. And you have to listen to where the economic moves are. Right now, I believe that we are starting to see a sideways move on interest rates, even though the inflation numbers were a little stronger this last month than people had expected. I still believe we're going to see a sideways move where we're going to see 25 to 50 basis point rise. And then eventually the Fed funds futures rates are looking for them to be lower at the end of this year, which is a real positive. So as crazy as it sounds, I think we're going to start trading towards 2024 earnings forecasts, and we're going to avoid a recession. But you can't also ignore the global nature. The United States is 5% of the world's population. We're the biggest economy, but we're only 5% of the world's population. And you have to look at what's going on in South America, what's going on in Asia, and in Africa. And these countries are not, or these regions are not growing as fast as they need to. 44% of the earnings growth for the S&P 500 comes from outside the United States. So you have to look at the rest of the world to see if, in fact, the rest of the world is going to be there to support the earnings growth. And that's the big question. The United States is coming along okay. It's not doing great, but the rest of the world plays a major part in the earnings of the S&P 500 companies. So you have to look, and South America, should be doing great, but you have these countries, where you have socialism and communism starting to spread, and you've got a real mess, in the south of our border right now, which is a really scary thing, which is very anti-growth and against capitalism quite a bit. So you have to be very careful as to where you're going to be focusing your business. If you're Procter and Gamble and Kellogg's, where are you going to get international growth?
Absolutely. I've want to just quickly change gears and talk about your book, Wealth Mismanagement. A Wall Street insider on the dirty secrets of financial advisors and how to protect your portfolio. It seems to me like when I don't know, my sense is that it's like there's only uncertainty. It seems to me like we never have just certainty. Otherwise, life and investing would be pretty boring if it was
right.
just straightforward. I know you get securities that are pretty solid and predictable. But in the context of what you were describing, Ed, where things are unpredictable, there is the war in Ukraine, and everyone's talking about, a recession. Maybe it is, maybe it isn't. And it's just uncertain. I know a lot of investors who look specifically at venture capital funds, and I've also been advised or informed like a lot of venture capital firms are actually not making as many investments as they should, and that's upsetting a lot of their limited partners. So in every context, it seems to me like there's almost like a holding pattern because of this quote unquote uncertainty. Your book, Wealth Mismanagement, and the idea of protecting your portfolio, in that context, I'd love for you just to walk our audience through this idea of wealth mismanagement and how do you protect your portfolio when we are in such an uncertain time?
Well, the book Wealth Mismanagement doesn't have a lot to do with current times. It has to do with the problem with Wall Street and the training on Wall Street on how people should construct portfolios. Because most people don't realize, they think that if you work at Morgan Stanley or Goldman or UBS, you've been trained on how to structure a portfolio and how to measure risk. And that doesn't happen. There is no training at these firms on how to construct a portfolio. So the book is really kind of my life in getting to the point where I realized that the whole industry was built on a web of lies. And people have this perception that if you work at Morgan Stanley, you have some built-in knowledge, and you don't. It's just a bunch of nonsense that you have some training on how to construct a portfolio and how to measure risk. If anybody asks a financial advisor, how do you measure risk? They'll sit there and say, well, we got some bonds, and we got some good stocks, but that's not how you measure risk. So that's what the book is about. Now, in terms of venture capital, and I agree with you that a lot of places are having a hard time allocating money, and these venture capital firms need to allocate money so they can get those management fees. Otherwise, they got to return that money, and they don't want to return that money. They've already got that money, spent somewhere. But the idea behind, the venture capital spending the money and finding new ways of putting it to work is becoming very difficult. And they're going to start to take additional risks. The AI, artificial intelligence, has been a windfall for these companies, and same thing with fintech. So, that's a real positive. But in respect to, how my book translates to protecting portfolios with venture capital, all I talk about there is that you should have some venture capital, but it's 0 to 5% of your money.
How do you see the world of venture capital evolving in the near future, given what you're observing in the space currently?
Yeah, I'll tell you, the venture capital people are a lot smarter than me. These are the people who sat in the front of the room and got straight A's and got their masters and doctorate degrees, and they're able to think of things and analyze things that I could never have done. Like, I would have passed on Google and Facebook. I'm just not that skilled at analyzing private investments, but I know people who do. And that's the nice thing about what I do, is I have a great network of people that I can rely on. And I know who is a trusted advisor. I know lawyers at a lot of the big firms in the Silicon Valley and which companies they're picking up on. But when it comes to analyzing individual deals, I'm not good at that. I'm better at finding venture capital firms to co-invest with than me picking an investment. I'm quite frankly, I'm a disaster when it comes to that.
So do you work, so you obviously work quite a lot then with venture capital firms is it a case of like you become an LP in their fund? Yes. Or?
Mm-hmm.
You do. Okay.
Yeah.
And so when you engage with a venture capital firm in the context of an LP, what do you look for with your LP hat on in terms of, types of fund, age of fund, size of fund, investment focuses, types of startups? You mentioned AI, fintech, for instance. Walk me through and walk our audience through, if you would please, Ed, on what your strategy is when you're looking at evaluating, well, I've got, 100 million to put into a venture capital fund. I've got these three options, and here's how I decide which fund I'm going to work with.
Yeah, I look at the pedigree of the people. I look at the history. I look at what space that they're in. And, those are the beginning points. Then when it gets into the minutia, I just literally have blind faith that these people are doing this and they're doing it properly. If Sequoia was involved with the deal and then Technology Crossover Partners wanted to be involved and Kleiner Perkins wanted to be involved, then you have to figure that if everybody wants to be involved, there's something worthwhile there, because they have a way of making companies winners. But some of these unicorn companies, I could never imagine. I mean, there's one right now, SpaceX, which everyone is getting behind, and they have a $150 billion valuation. And I couldn't for the life of me understand it until someone just explained it to me literally yesterday. And he says that it's going to be $1 trillion company. And he was very convincing of it. So I'm either, completely gullible, or I have to learn from people who are in this space, who understand it. But these unicorn companies where they don't have any earnings, but they look you in the eye and say it's worth $1 billion. You're thinking, well, how in the world is this worth $1 billion? But somehow they come out and they're worth, several billions of dollars. So, again, I don't want to, kind of mislead anybody in thinking that I'm this genius venture capitalist. I just try to find the best pedigree and then ride on their coattails and try to see if anything they say makes any sense to me.
Mm-hmm. And do you work in your mind? Are you looking for a particular payback period? Like what time value period of time are you looking to get a return when you're engaging with a venture capital fund as an LP?
Yeah, I like to see 5 years, which, in this day and age is not outrageous. People will say it takes 7 to 10 years for companies from the very early stages to have a liquidity event. Nowadays, a lot of companies are having liquidity events through SPACs and also just getting bought out, which, I have no problem with. It's much better to do that than go through, the IPO process where you're locked up. So, I look for about 5 years, and that to me would be ideal.
Right. And you mentioned IPOs, Ed. How many IPOs have you been involved with throughout your career?
Oh, probably 100. I was the investment banking services representative at Morgan Stanley in the late 90s. So every IPO that came out, I was involved with. And, you can take it from Ariba to Metasolve to Vignette. I can list, tons and tons of companies. So I understand the IPO process very well. And I also understand the Section 16B officers and how they get locked up and how frustrating that is for them.
Yeah, I'm sure. What actually leads to that for our audience who may not know exactly what you're referring to?
Well, Section 16B officer are the founders of the companies and the insiders, and they're limited on how much they can sell. And they can only sell during open windows where they have announced earnings and everything is public, and they have 10 days where they can sell. Then they can set up a 10B51 plan, which is a reoccurring selling program. And that seems to work as well. Those have become really popular. But the Section 16B officers are usually the ones that are there when the stock soars, and they're still there when the stock plummets, because oftentimes these stocks get hyped up and then they come back to reality at some point.
Yeah, they do. And on that bombshell, we're going to take a quick break. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. Ed, you've obviously got a wealth of experience. You've made a lot of money. I'm sure you're very successful, and also you would have, I'm sure, like anyone else, made a lot of mistakes. What would you say has been the greatest success and failure in your career, and what would you say made the difference?
Boy, that's a great question. In terms of success from an investment standpoint, I think one of my greatest successes is kind of an embarrassing story, but I put a man in Florida Progress. He was a very small client, had like $10,000, and I put him in Florida Progress. And I forgot about him. I didn't talk to him. I was a young broker, and he called up one day and said, "I just got to thank you. You did such a good job for me." And I thought, okay, who is this? And I started looking him up, and I realized I had tripled his money by doing nothing. And I realized at that point that oftentimes people in my industry feel like that we have to be involved all the time. And it was a great lesson, because sometimes, if nothing changes on an investment, you just leave it alone. And people in my industry think we have to constantly be meddling and doing stuff to show our value and to show that we're worthy of our management fee. And, and this was, again, I was very, very young in the business. I had just opened up the account, and I put him in Florida Progress, which was a utility company based in Florida. But he thought I was the greatest thing in the world. And I just thought, yeah, I was great. I didn't even remember who he was. But that was a great lesson I learned about showing our value has a lot to do with not making changes and telling people what not to invest in versus feeling as though we have to be meddling. Because too often people are always trying to, make changes in portfolios to support their value. So I think that was a good lesson. A bad lesson would be, selling out of things before they were ripe. Eli Lilly, I remember buying Eli Lilly in my own account, and I sold it after it went up 10 points, and there was no reason for me to have done that. And it just continued to go higher and higher. So oftentimes what my best lesson is and my worst lesson are kind of the same. And that is that the amount of time in the investment is really of value. It's not the timing of your investments. From a career standpoint, I would say leaving Morgan Stanley was probably a bad move on my part. When I left there, I got sued by Morgan Stanley for $32 million to not compete and not go after any of my old clients. So I didn't. And that really messed up my business quite a bit. And I have a lot of friends back at Morgan who are living a much better life than I am right now.
Yeah, well, onwards and upwards, as they say, right? You mentioned it's unreal. Ed, you mentioned the word timing. I don't know if you know a guy called Jack Bogle, but he has this quote. It's like there are two types of investors: those who can't time the market and those who don't know they can't time the market. So in your experience, is that true? Because, it was interesting. It was another thing that Ben Lyons was describing to me. He said, he was chatting to a generationally wealthy individual, and he said to him, what's your advice about timing and wealth creation? And he said, what you said. He said, I sold too early. I should have just left things alone. I shouldn't have touched them. I shouldn't have meddled with them. Because if I had left that seed, or maybe not even seed, but that tree to keep growing into this massive oak tree, then I would be a lot wealthier, today than I am. So from a timing perspective, is it true to say you can't time the market? Because, I don't know if you know Bill Gross, but he is a very successful founder. Built and sold multiple billion-dollar companies. And he did this TED talk, and he said, what is it about? Is it the team? Is it about the business model? Is it about the size of the market? Is it about being first? And he looked at his own startups and a bunch of others, and he was saying that timing is the number one thing. So with all that said, Ed, what is your perspective on timing the market versus holding assets versus deciding, hey, I need to offload this bucket of securities?
Yeah, I'm surprised he said that timing was so important, because when you look at the Gibson book, and there was a study done, the Biebauer study, about the what makes portfolios grow. Only 2.1% of the growth in a portfolio has to do with market timing. 4.7% has to do with security selection, and 90% has to do with the top-down approach. So, but obviously he's sold more companies than I have, and he's wealthier than me. So that usually, makes somebody seem smarter. But when I look at the investments, it's the amount of, it's not getting out of something because something went down. You have to look at the fundamentals, and if the growth projections are there. Right now, like 3M is a good example. 3M, is not doing very well, but that doesn't mean you sell out of 3M. You might add to it when it goes lower, but people tend to compress time because we have these, 24/7, phones where we can look and see the value of things all the time. And people feel like they have to make adjustments. So we're constantly, jittering and, wondering, do I sell? Do I buy? Do I sell? And so when I think about, your question, I think the best answer is that you have to constantly be evaluating to see if something has changed in the company. But most of the time with these very big companies, things don't change. Like Nextera, NEE, just, I have a cost basis of $8 on that, and it's at $77, and they just increased their dividend. And that's a great example of me just letting things go. And the only problem with that is that I can't now do anything with that money because the tax gains are so big that somehow I have to show the client there's some value to me because we're locked in there, because we have, almost a 10-time return on that particular utility company. Yeah. So I think that it's not, I think it's more of, hold on to things and evaluate things and constantly be checking to see if anything fundamentally has changed. From a technical standpoint, things are changing all the time. But fundamentally, I don't think things change that quickly.
Yeah, it's interesting because you ultimately you got to make a decision. And because we're humans, and I know, if you listen to Ray Dalio, he speaks about Bridgewater and the role of artificial intelligence and how they manage portfolios. It's like, there's actually this, I think there was I remember seeing a picture of like the New York Stock Exchange in the 80s, and it was just rammed, like 10,000 traders under a roof. And then fast forward, 20 years, and there's basically 10 people. Because of AI. And so what AI is doing, it's doing things that we can't do. It's crunching news releases, press releases, events, trends, and different points of leverage, different asset classes, different, you name it. And it's doing it all in a fraction of a second. And so I'm curious to get your view for those of us who don't have access to that kind of capability. How do you personally stay informed about market trends and economic indicators when making investment decisions?
Yeah, I have access to all the research. So what people don't understand is the amount of work that I do, keeping informed on everything that's happening in the world. I mean, you can ask me about any region in the world, and I'll either know an answer or I'll act like I know an answer, and I'll be very convincing of it. But when it comes to technology, because technology has become so efficient, the moment something happens, in China, it's reflected in the pits in Chicago, even though the pits in Chicago don't exist anymore. But so things happen so quickly. That's why there's such high correlation between publicly traded securities. The emerging markets are very highly correlated to the developed markets, going back to what Ray Dalio was talking about because of AI. And, the artificial intelligence is not just the communication system, it's the analytics that go on. And, there's just so much of that's happening. I'm not exactly sure how Ray Dalio is trading with AI, but I would be interested to know how he's doing that. But I do believe that the amount of information out there does not equal knowledge. And that's the big difference. You have access to information, but you have to have knowledge. And I don't think that the AI has translated that into knowledge just yet.
Yeah, until it does. Because that's what I'm thinking about. Like we were, I've been saying this on the show lately, but like AI was always like a thing that was happening in the future. Like 8 years ago, there was a talk I was watching from a guy in Cannes. I was there for the advertising awards, and he was saying like, look, take the next 10,000 startups, just add AI, and like that was 8 years ago, and then there was a lot of lip service happening to that, and then suddenly around Thanksgiving last year, then ChatGPT happened, and now it's like, oh, so it's not lip service, it's actually, this is a real thing. This is artificial general intelligence. And I think about, because I'm doing just foraying into security, my security exams at the moment, and and I think about, well, if you were an individual investor and you wanted to get into options trading, and you had an AI platform that could do options trading in a fraction of a second, and you are using it to leverage your portfolio, so the most you could ever lose is the premium, but you get unlimited gains. And you just said, look, here's 10 grand, and here's a trading platform, and go and manage my portfolio for me. Like, that would be an amazing investment, I would suggest, if the AI was actually capable enough to do that. How far away do you think, Ed, if you were to put your futurist hat on for a moment, are we away from having access to that kind of technology as retail investors or accredited investors who don't want to know how options trading works exactly, but they just want a capable data engine and a decision-making engine to manage it for me?
Yeah, I think we're very, very close to that. I had an investment in something called Plenum, and it was a hedge fund that would go short. It would buy the five mini S&P futures contracts and sell simultaneously. So there was a 40 millisecond difference between them buying and selling and arbitraging a very small difference. And they would do about 1,000 trades every hour. And this was back in 2014. So nowadays, I'm sure that there are programs out there that are set up to be able to figure out, if the market does this, then you sell this, and the market does this, you buy that. And I'm sure that we're not far away from, computer trading programs like that, because they have computer trading programs on stocks. When it comes to options, I'm sure that, there's something that's already, built that is being tested that will end up becoming, some black box strategy from, could be, from who's that guy? He's out in
let me Google it. Who am I looking for?
Jim Simon. Jim
Simon. Okay.
Right. Renaissance. Now, I'm sure that, some of those people have got these figured out already and are already working towards it. So I don't think we're that far away from it.
Right. I want to change gears completely and just talk about you, Ed, for a moment. You mentioned your dad up front, being involved in the space. What's the greatest lesson he ever taught you about investing?
My father was not a wealthy person. He grew up in a tough home, and so when it came to investing, he didn't have a lot of knowledge or advice, because he was an attorney. But he always was afraid of going poor, and he never did. He passed away about 20 years ago. And so I think that I have this constant fear of financial ruin. And that's why I'm never the kind of person who can buy something. You hear these people who buy something at $1 and hold on to it till it's $200. I'm the kind of person who buys it at $1 and I'm out at $2.50. I just don't have the kahunas to stay in there. But I also say that people who are really, really smart will never get tremendously wealthy through investing. And that might sound weird, but if you take a guy like Mark Zuckerberg or Bill Gates, and you say, I want to take 99.999% of everything you have and put it in one company, you'd be like, you're crazy. There's no way in the world you would do that. Just like Mark Cuban, he made all of his money from one company. And to me, so concentration is a great way to get rich, but it's a terrible way to manage money. And I think most people try to replicate the really rich people. And if they do, they're doing it wrong. They shouldn't be trying to replicate the really rich, because the really rich got there the wrong way.
That's such a great saying. I'm going to steal that one. But it is true. I mean, I would say like there's paths to wealth, right? So if you come from generational wealth, that's what it is. But if you are ambitious and you're young, a job is not going to get you there, most likely. Very, very rarely. And then the alternative is to build a business, and to build that thing quickly and to create something that can scale through some kind of platform, or maybe there's a commercial point of leverage in the investing space or in the venture capital space, as an example. But to your point, the path to wealth, and if you focus on it, is creating an asset, which is a business.
Mm-hmm. So going back to something we talked about earlier on the athletes. So when I talk to, and I'm having a meeting next week with an all-pro lineman. I'm meeting him for the first time, and I'm going through my class with him about how to manage money properly and how to never go broke. But one of the things that is not taught is how to build a business without using your own money, because a lot of these athletes will go out and use their own money because they don't know how to go and borrow money or put a business plan together to get other investors to reduce the risk. So they're putting their own personal wealth at risk when they're trying to start a new business. There's a gentleman, an all-pro linebacker in New Orleans, who was putting a school together. He's a wonderful guy, and he's putting a school together, and he was going to fund the whole thing himself. And then I got a hold of him and said, no. Get other people to invest in it, because the school itself, he was going to start off with 10 people and then 20 and then 30. And the business plan was sound, but it wasn't a perfect business plan. But if he did it all on his own, he would have been out there with $2 or $3 million that was risk of his own money versus spreading that risk to other people. And I think that's something that gets lost in the education, not just to athletes, but to anybody who wants to start a business, is how do you properly organize and fund that business? That's a really good lesson that everyone needs to learn.
Yeah, OPM, right?
Yep, exactly.
Cool. Let's wrap this up, Ed. If you could get into the Matt Brown Show time machine and go back to yourself on day one of this investor or investment journey that you've been on, what advice would you give yourself after all the years of doing what you do about investing?
Great question. And normally I get used to knowing what the questions are going to be before, but I'm not prepared for this. So give me a second. I would say that don't lose money for people. And I think that people are 2.5 times more upset about losing 10% of their money than they are making 10% of their money. And understanding what you do for a living. I didn't learn my industry really well until I left Morgan Stanley and went off and got with Chris Gatesy from the Wharton School and really started to learn and understand correlations and Sharpe ratios and how the institutional people manage money and how we should be doing that for individual investors. So I would say I would have to, learn a lot more about my trade and understand the inner workings of what it is that we're out there talking to people about. That would be the number one thing.
Awesome. Amazing. Ed, thank you so much for being on the show. It's a real privilege to have had you on the show. You're doing amazing things. Thank you so much for being here. And wishing you all the best for the future.
Well, thank you very much. I appreciate it.
Anytime. Cheers, everyone.